Hey there, Investorholics. Welcome to another overview. Today we'll be looking at property ETFs. So we invest in the best ASX property ETFs. Got a bit of a selection here of the ones that I think are quite possibly the better ones to look at. So we'll review 4. So this gives you a bit of an opportunity to know the Aussie real estate investment trust landscape. So for those who don't know, REITs are listed vehicles that own and operate property, mainly collecting rent, not running a business. REITs are required to pass income through to investors, not retain it. REITs are not companies. They do not pay company tax, and distributions are not franked. The sector is traditionally susceptible to sharp interest rate rises, and economic slowdown, or rising competition. So while REITs can be a good source of income, the sector's growth characteristics mean investors need to take a long-term view. So we buy and hold, or buy and review after every 12 months, looking to hold. The strategy should be used as a supporting player in a broader portfolio. So what everyone kind of says is, we have our core and our satellite, so we don't put all our money in one specific sector or stock or whatever. Hang around. I think it's going to be interesting, and hopefully we get some, give you guys some value anyway. Hey there, Investorholics. This is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at Crack the Sky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up, and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. So the gene pool here, we're going to have a look at VBLD, which is the Vanguard Global Infrastructure Index ETF. Following on, we'll have a look at DJRE, which is the SPDR Dow Jones Global Real Estate Fund, State Street. Next up, we're going to have a look at SLF, which is the State Street SPDR S&P ASX 200 Listed Property Fund, and then we'll round it out with a quick look at VAP, which is a Vanguard Australian Property Securities Index Fund. I think they're probably, 4 of the better ones. Definitely the two main ASX focused property trusts here, and then we've got a bit of a smattering of some other options. As with all these ETFs, there's a myriad of options. Really depends on your preference and how you want to play the game, how you want to build your portfolio. So hang around, guys. Hopefully it's going to be interesting for you. Okay, so let's kick off with a look at the Vanguard Global Infrastructure Index ETF. Investment objective here, Vanguard Global Infrastructure Index ETF seeks to track the return of the FTSE Developed Core Infrastructure Index with net dividends reinvested in Australian dollars before considering fees, expenses and taxes and all those good stuff. So just a quick overview of the fund. The ETF provides low cost access to infrastructure securities listed in developed countries, so no emerging markets covered here. It offers investors diversified exposure to infrastructure sector, including transportation, energy and telecommunications. The ETF is exposed to the fluctuating value of foreign currencies, obviously because it's investing globally. So there will not be any hedging of foreign currencies to Australian dollars in this one, so it's unhedged. So the Y factor, competitive long-term performance. So Vanguard Investments approach provides investors with an efficient way to capture long-term market performance. Diversification, which is what we kind of like here. The fund invests in diversified portfolio securities, which means the fund is less exposed to performance fluctuations of individual securities. Following up here, number 3, low cost of investing. The fund has low ongoing fees as Vanguard strives to minimize the costs of managing and operating the fund. And also another thing to think about when we're investing in ETFs is liquidity, so we can get in and out of ETFs quite rapidly. As long as the market's open, you can buy and sell, which is a little bit different to a managed fund where you have to submit your letter and it takes a day or whatever before you can get in or out of those things. But the ETFs, it's listed on the exchange, you can get in and out quite rapidly. Okay, let's have a look at the dollars and cents here. When I put this slide together, we had a net asset value of 53.39, trading just above that at $53.52. Market cap was around 125 million. Management cost is a little bit higher than you'd like at 0.47, but this is an international fund, so you're got to take those type of additional expenses into account here. So you'll be paid a dividend quarterly, January, February, July, October, pretty standard for these type of REITs. Yields about 3.65%, jumps around obviously a bit with the share price. This one's relatively new, was listed in late October 2018, so sort of 2 and a bit years we've been running. So as I say, it's the performance hasn't been the best, but we'll have a quick look at that later on the next slide. So the unlisted fund has obviously had a bit longer history. So it was set up in 2007. And it's been performing reasonably well. I'd have to go back and double check that. Whether it's still running at 12%, I doubt that. Considering what we've been through in the last 12 months. So take that one with a grain of salt. So this ETF could be appropriate for investors seeking exposure to a diversified portfolio of global infrastructure securities that have the potential to generate regular income. So, and relatively stable dividends. So, I mean, really that's why I'm looking at ETFs, these type of ETFs in general, looking at income. Obviously, with all these, I'm going to say the same damn thing. Income has gone down in the last 12 months, just sheer fact of the unknown. But hopefully, these type of infrastructure ETFs, the income shouldn't have gone down too much. It should be relatively stable. So that's definitely one thing to have a look at if you're doing your research. Also have a look at IFRA and IGF. There are a couple of other alternatives that are similar to this, but different to the other 4 that we're going to talk about. So just gives some more optionality to have a bit more, do some more research and find out some more info. Okay, moving along, let's have a look at the top 10 holdings. Majority of North America, US, Canada for the top 10 here. Next Era Energy, Union Pacific, American Tower, Canadian Rail, CSX, whoever they are, Enbridge, Crow Castle, Norfolk Southern Corp, Duke Energy, and Southern Co. So, pipelines, American Tower, that is all your 4G and probably 5G towers in America, and they own some the towers and bits and pieces throughout Central South America as well. So, diversified, but between infrastructure classes there. So performance since we have listed, you're looking at it was about 4.8% per year. I mean, which isn't shooting the lights out, but over the long term, it's you'll definitely rack up the gains anyway, so plus your dividends and all the rest of it. So not shooting the lights out, but it's solid, I should say, solid. Okay, let's have a quick look at DJRE, which is the SPDR Dow Jones Global Real Estate Fund. So the objective here for DJRE, it seeks to provide investment terms before the fees and costs, blah, 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 closely corresponding to the performance of the Dow Jones Select Real Estate Securities Index. So the index is designed to measure the performance of publicly traded real estate securities, including globally traded real estate investment trusts and real estate operating companies. Quick look at the why factor, as in why would we bother investing in this one. So global diversification, which is diversification we always like, to an extent anyway. So global diversification, gives you access to sectors and countries that may otherwise be difficult for individual retail investors to directly invest in from Australia. Income, benefit from potential property rental income in the form of semi-annual dividends, potential inflation hedge. Real estate assets may help reduce inflation risk. Also, the one I don't really bother putting on these slides anymore is obviously liquidity. You can buy and sell these things quite rapidly. So yeah, I mean, that's definitely another plus. If you want to get in and out quickly for whatever reason, that is possible. Let's have a look at the numbers game here. So we had an SFA when I put this together of $19.82, trading just above that at $19.83. Market capitalization, $382 million. Management fee, like the other global fund, is on the higher side, so 0.5%, something to definitely keep an eye on. You're going to get a dividend twice a year in January and July. Dividend is about 3.58% when I put this together, but obviously that fluctuates with the share price. So, this ETF offers a simple and cost-effective way to gain access to a diversified portfolio of more than 200 real estate investment trusts and real estate operating companies, which are listed on major exchanges around the world. So, obviously, this is one that you can use for trying to get a little bit of international exposure outside Australia. Sort of gives you a similar, but not exactly the same exposure to this, as in it's not set up exactly the same as the Australian REITs. Something to dig in a little bit more deeper for you guys if you're going to look at these ones to invest in. So almost 6% of the companies in the ETF are in the US. We'll have a quick look at that on the next slide. So keep in mind that geography of the companies, revenue generation is largely multinational for the DJRE holdings. The portfolio has 85% REIT holdings, which are typically dividend generating stocks. Yeah, so let's whiz along and have a look at the other slide. Oh, okay. For further research, apologies, you should have a look at rent and REIT, just as different options to this one as well. Yep, so as we sort of mentioned in the previous slide, most of these companies are US based or North American based, over 60%. Haven't heard of a lot of these ones before for obvious reasons because I live in Australia, but we got Goodman Group and that slips in there, and I'm pretty sure they're obviously international. Prolegis, Simon Property, a digital realty trust, Public Storage, Well Tower, Avalon Bay Communities, sounds like some kind of retirement village thing. Equity Residential, Mitsu Fudasan, Japanese thing or something like that. Realty Income and Goodman Group. Overall here, you're not really shooting the lights out. 6.28% annual return since inception in 2013. So, yeah, performance is a little bit better than the Global Infrastructure Fund, 2% or thereabouts. Okay, let's slip into having a look at the two Australian funds, focus funds I should say. So SLF, which is the State Street SPDR S&P ASX 200 Listed Property Fund. So investment objective here is, as always, to track the index as closely as possible. But yeah, and pretty much after your fees, get the return. So the index tracks a sub-index of the S&P 200. This index tracks performance of Australian real estate investment trusts and mortgage REITs. So, obviously that's focused on a subsector of the overall index. The Y factor, looking for potential inflation hedge. So real estate assets might help offset inflation risk. Diversification, low cost exposure to the Australia's largest listed property trusts and investments across different locations and sub-industries. So they pretty much cover the whole thing for you. Capture income, property income in the form of dividends and potential for franking credits. Franking credits, so this pretty much non-existent because trusts don't pay franking credits, but there may be some things in there that aren't set up as 100% as a trust. Okay, let's look at the numbers. When I put this together, trading at $11.68, trading just below that at $11.67, market cap of 568 million, almost 569 million actually. Management costs here 0.4%, which is not too bad. Starting to go down in cost here. So we're going to see a dividend paid quarterly, March, May, August, November, which is a very nice. Dividend yield jumps around a bit, actually probably should be about 3.5%. That's one I'm not 100% sure about, but needs a bit further research, so it's running about 3.5%. So SLF aims to fully replicate the S&P ASX 200 A-REIT index. You're looking at about 22 companies, and that's the large cap Aussie listed property names. So despite a wide array of promising alternatives to investors for exposure to property space, SLF, I think, remains an economically interesting avenue for Australian listed property segment. So, probably one of the better ones to have a look at. So SLF, as we sort of said before, is probably really something, just to generate income. A regular income stream. Okay, let's have a look at the graph. So performance since inception is pretty good. Inception of this ETF was 2002. Wish we had got onto it in 2002. We've got Goodman Group, S Centre Group, Stockland, Dexus, Mirvac, GPT, Vicinity, Charter Hall, SCA Property, and Charter Hall Long. So if you're driving around any major city in Australia, you're going to see your shopping centres with a lot of branding of these major companies on it. So you can actually see these brands around town when you're going to shop at your local shopping centres, the big malls and whatever else. So Australian REIT market is quite concentrated, with the top 10 holdings in the S&P ASX 200 REIT index accounting for more than 86% of the portfolio. As you can see, it's quite top heavy for Goodman Group there. Considering the limited opportunity set of the market is difficult, so it makes it difficult for active managers to create significant alpha generation prospects. So pretty much passive strategies make a worthwhile option for investors looking for domestic real estate exposure. So pretty much the index is not prone to frequent changes. So we're looking at a very, very low turnover, 2%, so that keeps your costs down. And that's one of the things we need to look at. So this one gets a bronze rating from Morningstar. Yeah, I mean, I like it. There's really only the two major indexes really, ETFs to look at anyway, and this is one of them for if you want to look at focusing on Australian anyway, in my opinion. Okay, let's quickly have a look over VAP. So the Vanguard Australian Property Securities Index ETF seeks to track the return of the S&P ASX 300. So it's slightly different to SLF anyway. So VAP aims to track the price returns of the S&P ASX 300 A-REIT index, a cap-weighted index comprising 30 mostly large cap names. So suitability, so quite possibly for buy and hold investors seeking long-term capital growth, some tax-effective income. And obviously, when you're in the market, you got to have a bit of a tolerance for risk. So let's have a quick look at the why factor. Why will we bother buying this one? Competitive long-term performance. So let's go through. So Vanguard obviously is very similar to the VBLD. So Vanguard investment approach provides investors with an effective way to capture long-term market performance. Diversification, this is all kind of the same type of spiel. The fund invests in diversified portfolio securities, which means the fund is less exposed to performance fluctuations in individual securities, so smooth out the highs and the lows. Low cost investing, which is what we like. The fund has low ongoing fees, as Vanguard likes to minimize the fees. So yeah, moving on, all pretty straightforward. Okay, so the numbers, net asset value of 81.12, trading actually a fair way above that at 81.34. So obviously people are trying to get hold of it and pushing up the price above the net asset price. Market cap 1.8 billion, so this is the biggest listed property trust in Australia. Management costs 0.23%, so obviously the bigger these funds get, the lower their fees should become, especially when they're just focused on following the index in Australia, not trying to follow some global index, and that's why the cost for the two global funds were quite significantly higher. You get a distribution, quarterly distribution in January, April, July, October. Dividend yield is about 3% or a little bit over. So VAP is the largest property ETF in Australia, which gives it significant advantages of economics of scale, as I touched on. Vanguard's vast resources and indexing capabilities and commitment to low fees lend well to its suite of strategies, including VAP, obviously, because that's what we're talking about. So for those type of reasons, give and given the narrowness of the sector, I think it's a pretty good choice for an investment, in my opinion. Anyway, I'm not a financial advisor or anything like that, but that's just this is just one that I like. So VAP is the only ETF that tracks the S&P ASX 300, and like I said, the management fee is very, very low. So have a look at MVA, which is pretty much one of the only two here that we haven't touched on. We've touched on SLF and DJRE, but have a look at MVA, which is another option. If I was going to look at 5, I may have looked at MVA as well. So that's the Australian focus one as well. So have a look at that. Okay, so we're going to look at the performance here and the holdings. So the holdings aren't really anything that we haven't seen in SLF. It's just VAP holds about 30 REITs instead of 22 or thereabouts for SLF, so it's slightly more diversified. So as with all these things, the cap weighted benchmark is highly skewed with just 30 companies in the index, and it holds top 10 names weighted, so pretty much the top 10 take up 81% or thereabouts. Goodman Group, you're looking at 23.4%, S Centers 12.5% or thereabouts. And they're the two largest weights. Obviously, you can see at the top there in the right-hand column. This one is rated by Morningstar as silver, so this is the highest rated property ETF, property index ETF that tracks property indexes in Australia, if I can get my damn words out. So this has probably performed the best. Yeah, so this has performed the best over time. We'll have a quick look at the performance in the next slide, but you're looking at a bit over 10% per year or thereabouts, which is pretty juicy, if I do say so myself. Okay, so the verdict. Let's have a quick look, run over some more numbers. So Vanguard Global Infrastructure Fund, for me, this is one that I would not bother looking at right now, to be honest. DJRE, Dow Jones Global Real Estate Investment Trust. Yeah, look, I'd say you could probably put your money somewhere better. You're getting 6% per year returns. I mean, it isn't the best, it isn't the worst, but I think you could probably put your money somewhere else. And I say, look, at the moment, it looks a bit expensive as well. Looking at trading, both of these are actually trading above their net asset value, and when they're trading above their net asset value, you shouldn't be buying them because you're overpaying. You don't want to be paying more than their net asset value. You really want to be buying these ETFs when the price for the ETF is actually lower than the net asset value of the ETF, if that makes sense. So SLF, State Street Spider, S&P ASX 200 Listed Property Fund. I like this one. Also, I think Vanguard Australian Property Securities Index ETF's worth a look as well. So, by far the biggest ETF, which means it's going to be much more liquid. And the difference between the buy and the sell price is going to be closer as well. So that means you'll be able to pick up your shares at a better spread. Spread's not as wide. With all these property REITs, the dividends have come down quite substantially, so that's something to keep an eye on. But you know, if what we're doing here is we're looking for income and capital appreciation over long term, we can hold and ride out for a year, because you know, even though there's lots of doom and gloom about the whole property sector and specifically you know, like shopping centres and big malls and things like that, typically it never turns out how people are predicting. So I mean, I'm happy to buy and hold more of these. So I personally, in my income portfolio, I own SLF and VAP. The main reason I own both of these, because they're probably the best performers. They're both the two largest ones, and I've got international exposure in a different sector, so I haven't bothered buying the Vanguard Global Infrastructure Fund or the Dow Jones Global Real Estate Fund. So I've got a different ETF that gives me exposure in a different way to global investments. So I use SLF and VAP in conjunction for the sheer fact that if you look back at the SLF slide, you'll see that it pays dividends in the alternate months to pretty much all the other ETFs, REIT ETFs, and you know, the quarterly paying ETFs in general. So what I do is 1 month you get a dividend from SLF, and then the next month you get a dividend from VAP. So with my dividend portfolio, I'm trying to generate income every month. So I'm looking at a range of different optionality to do that, and these two REITs help me do that. So because SLF pays out of sequence to pretty much 99% of all other ETFs, SLF is actually quite a larger holding in my portfolio for that fact, because it pays the alternate month where there's a lower amount of income from the rest of my portfolio. So I definitely do use these in conjunction, but like I say, it really depends on how you want to get your international exposure. I've got, you know, my income portfolio is made up of 7 different ETFs or listed investment vehicles, and they're structured specifically to do different things and make sure that I'm not overexposed to certain things, and I get international exposure and all the rest of it. So yeah, so I would definitely be happy. Well, I do own SLF and VAP, and I use them in conjunction, and they're probably the best 2 out of these 4. Vanguard is rated silver by Morningstar. SLF is rated bronze. DJRE is bronze. Can't remember if Vanguard Global Infrastructure has a rating, but it's probably about the bronze anyway. But yeah, I'm happy to buy and hold, ride out whatever bumps and lumps there are in the market at the moment. If there's anything major changes, then we'll have to change our strategy. But right now, I'm happy with what I've got, and like I said, I do own SLF and VAP. For what it's worth, I'm not a financial planner, I'm not an advisor. That's just how I like to set up my income generating portfolio. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing, We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are, expand your investment horizon, and crack your financial sky. Thanks, guys. See you later.